I know, Esty, that you've been focused on the debt ceiling story. Thank you very much for joining us. Why do you see this creating a headache for investors then? What is going to be the link between the debt ceiling narrative and equity market volatility?
Well, we've seen the market so focused on trade and on the Fed, and both of those seem to be going in the right direction now. So the markets have been quite sanguine about the debt ceiling, and it hasn't really caught investors' attention. It's probably not a long-term market consequence, but in thinner trading as we get into August, and with news this week that indeed they could run out of money sooner than they expected, and that will give very little wiggle room and time for them to pass an agreement. I think it will just add some volatility to markets as we start to see those headlines, and we're seeing extreme partisanship as per some of the headlines around this situation in the U.S., and it might just exacerbate it.
I mean, extreme partisanship is probably not going anywhere, Esty, but volatility is something it looks like this market could use. I'm looking at a chart of the VIX here. This is just a one-year chart, but it shows the spike in December back down to 12 right now. When do you expect this to start picking up, and is it maybe a good time to buy, a good price to buy vol here?
Well, I think we're in probably a new normal for the VIX index. In any case, I don't think we're going to go back to some of the levels we used to see. We have central banks that want to keep investors investing and in the markets. They don't want to have too much of those moves. So, yes, when you see this type of retreat and where everything just seems to be rosy, then it can be some protection, but it doesn't mean it's going to spike either. I think we're just going to see a few more of those days like we saw in the last few months and not at the beginning of the year, where you have much bigger moves in intraday markets.
And on the trade front, we've seen some headlines, Steve Mnuchin talking about how trade calls with Chinese officials are likely this week. So we see this sort of drip of small news items, Esty, on the trade agenda. You suggest that maybe there's no incentive to do a deal on trade until later in 2020. Talk us through your timescales. Well, at the moment, there's really no incentive for President Trump to stop being tough on China. He risks getting attacked both from his base that sees China's evil and from Democrats for being soft on China. So if he's starting to think about his re-election campaign, coming to a deal right now when the U.S. economy is still doing well and markets are doing well isn't really in his best interest. Having exactly the kind of news we've had since the G20 in Osaka works very well. We've avoided a further escalation. Yes, we still have tariffs, and we shouldn't forget that this isn't, back to where we were a year ago. But you don't have a further escalation. You keep having these headlines, as you say, where they're going to have phone talks, and if that goes well, they'll travel and talk again. And that means you don't have too much of a deterioration in sentiment. Equity markets continue to do well. The Fed is expected to provide some cushioning in the next few weeks, and possibly with even a further hike later this year. It just allows the narrative to continue and for this tough on China story to continue. If you have an agreement way too soon, then it's definitely positive for both the U.S. and the global economy, but it does open President Trump to comments.